Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is one of the world's most popular restaurants a good investment? In this video we will be analyzing if McDonald's stock is a buy. Could McDonald's, stock ticker symbol MCD, be the catalyst for a new bull market? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on McDonald's. McDonald's was founded in 1940 as a drive-in restaurant. After buying the company from the original founders in 1965, Ray Kroc expanded the franchised burger chain exponentially, featuring hamburgers, cheeseburgers, French fries, chicken sandwiches, salads, and beverages. McDonald's has since grown to become a large international company with over 200,000 employees globally. Today the company serves nearly 70 million people daily and can be found in 118 countries. Now let's look at the price action. Starting with the 1-year chart, we see that McDonald's had a CAGR of about -6%. Zooming out to the 5-year chart, we see that McDonald's had a CAGR of 7%. McDonald's has been a steady gainer long term but has had a pullback recently. If we perform a backtest comparison of investing $10,000 in McDonald's versus the S&P 500, we find some interesting results for McDonald's. In that comparison with the S&P 500, $10,000 invested in McDonald's would have grown to $17,932 or a 12% CAGR versus $22,796 or a 17% CAGR if invested in the S&P 500. This demonstrates underperformance for McDonald's. A McDonald's investment would have been slightly more volatile with a 19% standard deviation versus 18% for the S&P 500. McDonald's underperformed the S&P 500 in terms of the best year performance, for which McDonald's grew 28% versus S&P 500 31%, but outperformed on the worst year performance where McDonald's fell only 4% versus the S&P 500 18% fall. In terms of max drawdown, McDonald's fell 23%, slightly less than the max drawdown of 24% for the S&P 500. McDonald's did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Now let's hop over to market share and take a look at McDonald's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that McDonald's is categorized under fast food restaurants. Expanding the fast food restaurants tab, we can see that McDonald's is the second largest restaurant in this sub-industry. However, it is losing market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for McDonald's, ticker symbol MCD, and see that the market share is 2.68% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This is a pretty solid share of the food market. Unfortunately, the company seems to be losing market share. The 5-year market share CAGR for McDonald's is -2.16%. If we start in 2019, we see that the market share was 2.92%, 2.68% in 2020, 2.78% in 2021, 2.52% in 2022. and 2.68% over the trailing 12 months. We can see that the market share values are trending downwards over time. In this version of market share, we can also compare McDonald's with other companies or entire industries. When we compare the market share data for McDonald's against the entire restaurant industry, we find some interesting results. McDonald's generates approximately 17.4% of all revenue from publicly traded restaurant companies. Put another way, about 17 cents of every dollar spent at a restaurant goes to McDonald's. Despite this market dominance, McDonald's still seems to be losing market share to other restaurants at a rate of about 3.21% per year. Let's take a look at the fundamentals to learn more. Gross margin is 57%. This is very good for a restaurant company. Revenue has compounded at around 5% over the past 5 years and has reached over $25.5 billion most recently. ROE This company pulls in a tremendous amount of revenue. Looking at cash flow, we see a 4% CAGR over the last 5 years for operating cash flow, while capex stayed essentially the same during that period. As a result, free cash flow grew at a 6% CAGR. With capex holding steady over the past 5 years, much of the operating cash flow passes down to the free cash flow. Weighted average shares outstanding have fallen over the last 5 years, going from 765 million shares in 2019 to 732 million shares most recently. McDonald's has been buying back a lot of shares. In fact, nearly 1% of shares are retired every year. This is great for long-term investors and also helps boost the dividend per share growth. Now let's view return on invested capital. Return on invested capital has risen from 18.1% in 2019 to 19.3% in 2023. Though the progress is slow, we can see that the metric bottomed in 2020. McDonald's has managed to become a little more efficient every year since. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 3 days in 2019 to 0 days most recently, McDonald's has gotten more efficient over time. This is what I like to see. Although negative cash conversion cycle is better, 0 is not bad. Now, let's look at McDonald's debt. The net debt to EBITDA has fallen over the past 5 years, going from 4.4 in 2019 to 3.5 most recently. The company seems to be paying down its debt, which is currently at a manageable level. Last, let's explore dividends. Current dividend yield is 2.3% with a dividend payout percentage of 54%. While I would prefer this value be less than 50%, it seems McDonald's is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 8.3% dividend per share CAGR over the past 5 years and a 7.2% dividend per share CAGR over the past 10 years. McDonald's has maintained a pretty consistent single-digit dividend per share growth over the years. The fundamentals of McDonald's are pretty good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for McDonald's. It is a restaurant company with a gross margin of 57%. The 5-year revenue per share CAGR is 6% and the 5-year free cash flow per share is 7%. Great gross margin and good revenue and free cash flow growth. This is a good start. A return on invested capital of 19% is good and growing. Next, the cash conversion cycle of 0 days is great. Concerning debt, a net debt to EBITDA of 3.5 means that it would take McDonald's about 3.5 years of earnings to pay back their debt. So from a fundamental standpoint, McDonald's looks good. Now let's switch our attention over to valuation. McDonald's is undervalued relative to the S&P 500 with a ratio of 0.8. The price to earnings growth, or PEG ratio, is 3.1, indicating that McDonald's is overvalued relative to their projected earnings growth. McDonald's is one of the largest and most well-known companies in the world. It has tremendous brand value and customers consistently know the quality they are going to get is high. From our analysis, we know that McDonald's is a strong and steady, dividend-paying company. Management is operating at a higher level and driving efficiency, which results in growing free cash flow. My only concern is that despite having healthy revenue growth, McDonald's is still losing precious market share. This tells me that management needs to focus on restarting market share growth at the company. One avenue for growth is leaning into new concepts like the Cosmix restaurant. Drinks, particularly caffeinated ones, are notoriously high-margin products which should help McDonald's grow both revenue and free cash flow. A drive-through first concept also encourages revenue growth. Another lever to pull is the affordability of the products. With reports of Big Mac meals hitting $18, affordability has become an issue for some customers and is likely weighing on sales growth. Management has recognized this, with the CEO saying eating at home has become more affordable and that a lower price point would resonate with more lower income customers. The CFO added, we certainly know consumers are more wary of pricing, and we're going to continue to be consumer led in our pricing decisions as we kind of look forward to 2024. I think this is the correct approach. McDonald's may have to sacrifice some of its great margins to restart sales growth, but I think that may be best for long-term investors. McDonald's is an excellent company which has had a bit of a pullback recently. This may be a great opportunity for investors, though I would like to see signs of market share expansion. For me, McDonald's is going on the watch list. Many thanks for watching. What do you think about McDonald's and their shrinking market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.